Good afternoon, and thank you for joining us today. I'm Bruce Tatters, CEO of Red Cloud Securities. Today's webinar features Seabridge Gold, the premier gold and copper exploration development company in the world today, with all of its projects in politically secure regions of Canada and the US. We believe Seabridge Gold's late 2020 acquisition of the Snowfield Gold property from Pretium was transformational to the company. This transaction brought 30 plus million ounces of reserve and resource adjacent to Seabridge's own Mitchell deposit at the KSM complex. This providing significant developmental synergies, which we think was a game changer for Seabridge. Seabridge also boasts extremely exciting exploration portfolio projects, many of them in active exploration this year. We're extremely privileged to have Seabridge here today to update everyone on their progress and what they plan for the rest of the year. Today, I have two members of the Seabridge group, Rudy Franck, co-founder, chairman, and CEO, and Jim Anthony, co-founder and significant shareholder. Jim will begin by providing both an outlook on the gold market and the general economic forecasts that surround it, followed by Rudy, who will provide an update to investors today on Seabridge's plans for the balance of 2021. After a formal presentation, we will be taking questions live. Please send us your questions via chat and we'll get to as many as you can. You can type in your questions into the chat box at any time during the webinar. Don't wait till the end. To start, we'll handle the disclosures and then get right into it. For Seabridge Gold, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of their corporate presentation. For Red Cloud, I would highlight that this webinar is for informational purposes only and not be considered a solicitation to purchase or sale or any recommendation to buy or sell securities. And we note that this call doesn't take into account the particular needs of certain individuals. Participants should rely on their own investigation at all times and seek their own professional advice before investment. Please see our most recent research based on our website for Seabridge Gold for specific disclosures. So now I'll turn it over to Jim and Rudy to begin.
Well, thank you, Bruce. This is Jim Anthony speaking. So we're going to start with a little discussion on inflation, what we think of as untransitory inflation. So next slide. So here we have the traditional form of inflation, cost push, and inflation is ramping up. It's just like the 70s. US producer prices are leading, as you can see, upper right. They're accelerating very nicely. They have fed into US CPI month over month. That's the chart bottom left. And now we're beginning to see the impact on US wage growth, which is really the critical component to getting from transitory to untransitory inflation. And if you look at the May numbers, US wage growth was 0.5%, expected 0.2%, after 0.7% in April, expected 0.2%. So we see the full formula of prices moving through to cost push, wage growth, inflation, which is traditional in this type of ramp up as per the 70s. Next slide, please. Now, the second form of inflation, even more interesting, is money supply growth. It's accelerating also. If you look at the first 4 months of this year, the rate of inflation in the money supply, M2, is $244 billion a month, which is a 53% faster pace than the first 6 months of last year. This is the push behind inflation that probably is not as recognized as it should be, but you again saw that in the 1970s. Next slide, please. But we get to another form of inflation, Jim Grant's favorite, which is fiscal inflation. And here things get really interesting and a little bit arcane. If you look at the debt to GDP ratio of the United States, it has now crossed the Rubicon at 130%. The Rubicon is defined by Rogoff and Reinhardt. They've done the definitive study on this sort of thing. 130% means you restructure or you default. Now, there are lots of options for restructuring, and we're going to present to you the one that we're convinced the U.S. Treasury and Fed are actively considering at this time. So, next slide, please. Tapering is considered to be the option. Everyone's looking for tapering. The market anticipates tapering. Every time the market or somebody at the Fed talks about tapering, gold takes a small hit because tapering is not supposed to be good for gold, and tapering is supposed to be the Fed's option. We don't agree. The last time tapering came up in a serious way was in 2013, when the Fed signaled that it was going to taper in 2014. And we remember that, many of you will, as the taper tantrum, when yields, and you see in the chart on the left, popped on the 10-year, when we launched a US dollar bull market. And those things were hard to handle at 100% debt to GDP. At 130%, we don't see that happening, with trillion-dollar deficits in addition, and declining foreign funding for U.S. debt. So options may exist, and we'll get to one, but we don't think tapering is one of them. And as the market begins to realize that, gold is going to have a real bull market. It hasn't had one yet compared to what's coming. And if you look at the chart on the right, that tells the tale of why tapering doesn't work. The green line is the issuance by the Treasury. And as you can see, it's accelerating very nicely to fund all of the programs that the federal government seems to come up with. The red portion is the foreign funding of that debt. And as you can see, it's next slide, please. Therefore, tapering is not an option. Now, the problem behind that is the twin deficits. As you know, the prime economic formula, it's an identity really, is that savings equals investment, and that's how you get growth. The U.S. has had negative savings for years. That's been plugged, the hole's been plugged by foreign savers who funded the U.S. deficit and U.S. growth until 2018, when cross-currency hedging costs skyrocketed and it was no longer a viable alternative to buy U.S. debt and then hedge the dollar. So the Fed now must provide the savings as the U.S. deficit has exploded. Otherwise, no growth. And therefore, the release valve, the dollar must pay the price. Now, if you look at the chart to the right, that's a favorite of Steve Druckenmiller's. That's the green line is the US dollar index, and the red line is the twin deficits cumulative total. The twin deficits have been advanced by 18 months to reflect the fact that that the dollar follows it as the data works into the economic system and the foreign exchange markets. So what we can expect in the next 18 months is a virtual collapse in the US dollar, the green line, to go down and join the red line. There are very few instances in history where this has not happened, and none of them as egregious as the current set of data. Next slide, please. So here's what monetizing the debt looks like. You know, as foreign investors have stepped out of the Treasury market, including Japan, China, even Europe, therefore the Fed has had to fill the gap, and that's why there will be no tapering. Next slide, please. Now, this is a little busy, but we'll take our time with it and work our way through it. The only option that the Fed really has is the same one they had in 1946. History repeats. You can see in the chart on the right, the colored portion is the debt to GDP ratio, As you can see, it hit a high in World War II, obviously. And from 1946 to 1951, the Fed delevered its balance sheet. So it's done this before and it knows how to do it. It flattened the yield curve. We had yield curve control. And we had negative real interest rates. Yes, negative real interest rates of 14% in that period from 46 to 51. The Fed achieved its objective. Its debt to GDP ratio went from 110% to 55%, and we got back to normal. The market is expecting that now we can have a normal rate hike cycle, not at 130%. It's not going to happen. It can't. Now, what else is happening? If we look at the current policy of untransitory inflation, which I think the Treasury and the Fed are embarked on, Yellen and Biden have promised to go big. They promised net income programs to support families. They promised infrastructure spending. They promised carbon objectives that are very aggressive. The stimulus is not going to stop. What they're going to do is they're going to delever the balance sheet. They're going to do that by keeping interest rates well below the nominal growth rate. That means that the debt is being inflated away. We're going to see 1946 all over again. Now, there's a couple of things that point to this that probably most of you haven't noticed. There are two significant changes in the U.S. budget introduced just in the last couple of weeks. We now have a real net interest payment calculation. That is, what are interest payments on the U.S. debt after inflation? We also have a real net interest payments as percentage of the debt. Why do you think they are telling us these things? Because they're giving us a little sneak preview of the fact that real serious inflation is on its way, and it's a matter of policy because there are no other options. So I would like to just draw attention to the fact that a number of these slides and the reasoning, it comes from Luke Groman. I'd like to give him credit. His Tree Rings publication is well worth the subscription price. And what does this mean for gold? Well, it's going to be one of the very few safe investments to preserve your capital and actually gain in net worth. So with that, Rudy, I'd like to turn it over to you.
Thank you, Jim. So now moving on to the case for Seabridge and an update on the company. I feel a lot of reasons why I can point to why owning Seabridge makes sense, especially in the type of environment we believe we're heading into in terms of big inflation coming and perhaps yield curve controls being put in place. One of it is just the amount of gold that we have per share. And it's not only gold per share, but also copper per share. Another one is we own 100% of the world's largest undeveloped gold copper project. There's a big need right now for the major companies to find new projects. The gold industry is running out of reserves. The copper industry needs new production to satisfy increasing demand that's coming from green energy initiatives. And we're sitting with the largest one on the planet in a safe jurisdiction that is permitted. And then last but not least has been our ability to find gold over the past 15, 20 years. In fact, our exploration team has found more gold than any other company on the planet, and that includes the majors. As the market got hit 2015, 16, and 17, we took advantage of that and went out and reloaded our portfolio and have acquired now 3 new earlier stage exploration projects that we're about to conduct exploration activities on this year. This is a slide that I think tells our story best. Jim and I formed the company in October of 1999, taking over a shell. Gold was trading at about $260 an ounce at the time. And our goal was to create the best leverage play to a rising gold price that we saw in front of us. And we did that through the concept of growing ounces in the ground faster than shares outstanding. Our belief is that the more ounces we can provide on a per share basis, the more leverage and optionality our shareholders should have to the price of gold. And as you can see on this chart here, we have been successful on that front. In fact, if you look at Seabridge relative to the industry, whether you look at it in terms of proven and probable gold reserves or measured, indicated, and inferred gold resources, nobody comes close to us in terms of gold ownership per share. Bruce, I've lost you. Here we go, sorry. So what this has translated into, as we expected and hoped for over the long run, is significant outperformance in our share price relative to the gold price and other gold equities. Over the long run, our share price is up over 8,000% compared to an increase in the gold price of about 500%. If we're right and the gold price is about to go significantly higher, we have a 22-year track record of showing significant outperformance in a rising gold market environment. And if gold is going higher, so should our shares. I think what the market has not yet fully recognized, however, is we're not just about gold. We're very fortunate that at KSM, along with our gold discoveries, we also found a lot of copper. In fact, KSM today hosts 17 billion pounds of copper in the measured and indicated resource, and an additional 33 billion pounds of copper inferred. In total, over 50 billion pounds of copper. So in addition to the 2 ounces of gold per common share we have in all resource categories, we also have over 600 pounds of copper in the ground per common share. And as you can see, compared to the big copper producers, we actually provide better leverage to the copper price through the concept of pounds of copper in the ground on a per share basis. As bullish as we are on gold, we're also very bullish on copper. And this is just by luck. We were focusing on gold. A lot of copper came with it. And now as we look forward into the future, as a result of all the green energy initiatives that are being put in place around the world, which consume a lot of copper, our industry will not be producing enough copper to satisfy the demand. In fact, a lot of studies have shown that over the next several years, the deficit will continue to grow. They're anticipating a 30 million metric ton deficit cumulative between now and 2030. And Goldman Sachs recently came out with an estimate on their own saying that they expect the copper deficit in the year 2030 alone to be 8.3 billion tons above this estimate on this chart. To put that into perspective, the industry today is only producing about 23 million metric tons of copper a year. So copper demand is going up, new supply is not coming in quick enough, and that's just a great recipe for higher metal prices, which we're already seeing. Fact is, the copper price has more than doubled in the past year. Turning now quickly just to run through our portfolio, our 2 advanced stage projects, KSM and Courageous Lake, both in Canada. Combined, they have 45 million ounces of proven and probable gold reserves and over 10 billion pounds of copper. And then the 3 earlier stage exploration projects we've acquired since 2016 include Iskut, Snowstorm, and 3 Aces. KSM is the project that keeps on giving. We bought this project from Placer Dome in the year 2000. We paid $200,000 to buy KSM. We've now invested over $400 million into the project, defining not only the world's largest undeveloped gold-copper project as measured by gold and copper reserves and resources, but also a project that has tremendous capital efficiency, even at metal prices much lower than they are today. KSM is located in the middle of the Golden Triangle that's now getting a lot of attention, with a lot of majors coming into this area. Recently, we had Newmont step in and buy the GT Gold Company. Newcrest came in a few years ago, buying 70% of the Red Chris mine. And Teck is also a big player with Shaft Creek and Galore Creek in the district. Another great thing that's happened for us is the introduction of new infrastructure that'll lower our cost dramatically. Typically, when you have projects of this scale, you have to bring power in, you have to bring roads in, and you have to find a way to get your product to a smelter on the Pacific Rim. In our case, the government maintains a highway just to the east of KSM. Along that highway, the government has extended the power grid with cheap hydropower. We've now arranged contractual agreements with BC Hydro to buy 250 megawatts of power from this line. The effective cost of power here is about 5 cents US per kilowatt hour, some of the cheapest power in the world. And last but not least, just to the south of us in the town of Stewart, we now have two port facilities, one which was refurbished, and another one that's been built brand new that will provide year-round access to the Pacific Rim to bring supplies in and concentrate out. We are blessed with tremendous amounts of metal at KSM. We have 4 deposits that came along with the acquisition from Placer Dome: Ironcap, Mitchell, Sulphurets, and Kerr. And then, as Bruce mentioned, in December, we acquired a 5th deposit called Snowfield, which we actually believe is the sheared off top of the Mitchell deposit that was moved up the valley by a fault many, many years ago. Collectively, we have 9.8 billion tons of economic resources that are either confined by open pit shapes or by block cave shapes. As we went through the environmental assessment process and received our approvals in late 2014, we are now permitted for about 2.3 billion tons of tailings. So even though we have 9.8 billion tons of economic resources, what we've been focusing on, what are the most capital efficient mining scenarios that we can put forward? What is the best 2.3 billion tons that we can mine to generate the best returns? We finished a pre-feasibility study in 2012. That study was updated in 2016 and further reconfirmed just last year. That updated study captures just over 38 million ounces of gold in reserves and over 10 billion pounds of copper. And as you can see here on our base case, this project would generate an after-tax cash flow of about $10 billion. And that's using gold at $1,230 an ounce versus $1,900 where it's trading at today, and copper at $275 versus $450 where it's trading today. And as you can see on the slide here, looking at the pre-feasibility mine plan using 1850 gold and 450 copper, we see an increase in the after-tax net cash flow from 10 billion to 30 billion, and significant increases in net present values, internal rates of returns, and improvements in payback periods. As good as that mine plan is, we actually showed a better mine plan in 2020 that started to focus on the discoveries we made at Deep Kerr and Lower Ironcap after the 2012 pre-feasibility study was completed. We were able to show a study that captured 40 million ounces of gold and 19 billion pounds of copper within the 2.3 billion ton limit. And that economic study actually showed zero cash costs, and very low total costs at the gold prices of $1,230 and a copper price of $275. And it's only about to get better. In December, we completed the acquisition of Snowfield from our next door neighbor, Pretium. It's an asset that we've been following and actually been trying to buy now since 2008. The stars finally aligned for us with new management at Pretium willing to come in and do a win-win deal. We paid $100 million to buy this deposit from Pretium. They used the $100 million to pay down corporate debt on the mine they built at Brucejack. And we brought into our portfolio 35 million ounces of gold and 4 billion pounds of copper that were not available to us prior to owning this. We are now in the process of updating our pre-feasibility study to incorporate Snowfield. What we expect to see is a mine plan that can be open pit only for more than 30 years at a strip ratio of less than 1:1, capturing nearly 50 million ounces of gold in reserves and keeping the copper content high enough to provide the credits that are necessary. That updated study should be completed in early 2022. And in addition, we expect to see a significant improvement to the project's net present value and IRR, even better than what we were able to show in that mine plan in 2020 that captured the higher grade copper from Ironcap and Deep Kerr. Second advanced stage asset is in the Northwest Territories called Courageous Lake, an asset we acquired from Newmont and Total in 2002. It's a big system. It's a greenstone belt. When we bought this asset, there was about 5 million ounces. We've now extended that to over 11 million ounces and did a pre-feasibility study at Courageous Lake in 2012. At that time, the Canadian dollar was essentially at par with the US dollar, which is not good for a Canadian asset. You want a weak Canadian dollar relative to the US dollar to help drive economics. As you can see here, the base case back then at $13.84 gold and a 0.98 exchange rate generated marginal returns for this project. However, if you look at Courageous Lake in the context of today's gold price and today's exchange rate, what was marginal in 2012 looks very different today. We've also worked on some internal studies to look at, is there a smaller starter project that is available to us at Courageous Lake? And there is. And we're now working with a banker at looking for the best way to unlock value with Courageous Lake, which could involve a sale, a joint venture, or some other creative transaction to drive value to our shareholders. At one point in time, Courageous Lake generated a market cap to our shareholders in excess of $500 million. Today, I would say it's kind of lost in the market, and getting this back out front and center should help drive value. What we're excited about most, though, going forward are the exploration opportunities we now have through our three most recent acquisitions. Iskut is an asset we obtained when we acquired Snip Gold in a friendly deal a few years ago. It's a large land package about 40 kilometers from KSM. It has the same age of mineralization, the same rocks, and the same structural elements at KSM. We are now focusing on the gold copper opportunities there. Last year, we actually intersected some gold and copper underneath a lithocap and believe that we're now into a porphyry system. We'll have a follow-up drill program this year at Iskut, continuing to expand the known copper and gold mineralization and hopefully get into the heart of the system. The second acquisition was a project in Nevada called Snowstorm. We acquired this from John Paulson. Exciting about this, it sits on the intersection of the three most prolific gold belts in Nevada, the Getchell Trend, the Carlin Trend, and the Northern Nevada Rift Trend, and right in sight of two of the biggest mines on the north end of the Getchell Trend, Twin Creeks and Turquoise Ridge. We bought this project with the belief that we have same type of mineralization as exists at Twin Creeks and Turquoise Ridge. We'll be having our third drill program at Snowstorm this year. Our first program 2 years ago confirmed that we had the right structures running up into our property from Twin Creeks and also the right rocks. Last year's program confirmed that there is gold in our system, and this year we're hoping to vector into where the deposits that would be similar to Twin Creeks and Turquoise Ridge may lie on our property. The best place to look for new deposits is within eyesight of an existing mine. And as you can see here, the complex just to the south of us on the Getchell Trend here would be a great home for any deposits that we can find at Snowstorm. And then the third exploration project in the portfolio is Three Aces, located in Canada's Yukon, a project that we acquired at the height of COVID from Golden Predator Mining. We issued 300,000 shares to buy this. To call this a project really does it injustice. It is a district, over 300 square kilometers, 35 kilometers along a belt, and we believe that there's actually parallel belts to this within our claim block. This year we'll be hosting our first program here, starting with geophysics, followed by drilling. And if you look at some of the drill results that have been reported here historically, right at surface, they were able to obtain meaningful widths, multi-meters, of a half an ounce up to multiple ounces per ton. They also were able to run a small gravity plant there to show that metallurgically, this gold can be recovered in a simple gravity circuit. So finding high-grade gold near surface should drive value, and we'll get going on this project later this year. But just to wrap it up before Q&A, why invest in Seabridge? Unparalleled leverage to gold and copper on a per-share basis. KSM represents probably the best opportunity for the majors to go after for a new project for themselves. And then exploration. We've built the company around exploration success, and we now have 3 new projects in the portfolio to drive that value. We are dual listed. We trade most of our shares on the New York Stock Exchange in the US, also part of the GDXJ index. One other thing I would point out here is that insiders of this company own over 30% of the stock. And those insiders have been shareholders of this company for almost all of the 22 years that I have been the CEO of this company. We have a sticky, large shareholder group that is consistent in terms of providing the capital we need to initiate our programs. So Bruce, that concludes my prepared remarks. I think we'd be happy to take questions now.
Thanks, Rudy. I'm going to take off my glasses now that I'm on the screen. Appreciate everyone being on. First question for Rudy is a question about access, road plans, and costs I'm assuming that means for KSM.
Yeah, so the budget for KSM for full construction is a little over $5 billion. We are now updating the pre-feasibility study not only to take into account the addition of Snowfield, but also just to reconfirm and update all the costs. The access costs actually, as a percentage of the total capital, is not that great. It's less than 10% in terms of roads that are required to get site access, and also tying into the grid. So all of that has been factored into our pre-feasibility study in detail. I think the document is well over 1,000 pages. If somebody wants to go in there and take a look at the details more than it's available on CDAR.
Okay. Next question, it's from myself for Jim. Jim, you know I always like to ask you some questions.
Yep.
There's been a lot of instances over the last couple of decades, ever since both Bernanke and even predecessors to him, of the Federal Reserve letting the market dictate when they choose to act. I know that, and what I mean by that is, you're making it sound like they absolutely know that they need to run this course ahead of us. The question is, are they going to push the tapering narrative much further before they just clearly show that they're not going to do that? In other words, are we going to get into a rough market first?
Yes, I think we probably will. They're going to try to maintain their posture of transitory inflation and tapering coming as long as they can. That was, again, part of the strategy back in 1946. Part of it is to keep the public and the bond market particularly on side as long as they can. So yes, they will have to be forced out of that position by a serious decline in the stock market. And I think we can see that coming.
Or a backup in the yield curve
or
that they feel that they need to address, right?
Yes.
Which is what I was figuring.
Yes,
that yield curve management you sort of flagged.
It's exactly, and that also ties into the dollar. A higher dollar doesn't play well for their strategy.
One quick follow-up, and then we'll get back to the questions for Rudy. But given the rest of the world and the global COVID pandemic that we've had, and the balance sheets around the world similarly being challenged,
Yes.
Is that take some pressure off the U.S. dollar, the fact that the global picture is bleak for debt around the world?
Yes, it does. And I think you're going to see coordination of the central banks to let the dollar down gently and to manage things so that it's not just the dollar. I think you're going to see a new reserve currency that is developed in cooperation with the other central banks and the Bank of International Settlement. The special drawing rights are going to become more important. That's part of the strategy. In fact, you've actually had Janet Yellen talking about a new Bretton Woods. Bretton Woods, for all those who don't recall, is when the U.S. dollar, after the Second World War, became the prima facie reserve currency of the world and the way of settling trade imbalances through purchase of debt rather than exchange of gold. So I think they know where they're headed. They're not sure how they're going to get there or how much turmoil is going to occur as a result. But it's pretty clear that deleveraging has got to be part of the program in order to get back on side and be able to have regular rate hike cycles as we've had in the past.
Thanks, Jim.
Okay.
Next question for Rudy from the chat. Are the big gold producers interested into Seabridge as a whole takeover or a partial asset one? Are there discussions ongoing?
There are discussions ongoing, and there have been for joint venture discussions on KSM for many years. We have received a number of proposals over the years, have not yet got the deal that we will say yes to. And our goal is to do a joint venture on KSM and retain 100% ownership in the other assets that we own. So it's just a joint venture negotiation discussion on KSM. And it includes not just the gold companies. One of the great things about KSM now, it's not just gold, it's also a lot of copper. If you actually look at the metal mix at our 5 deposits combined, and you take into account metallurgical recoveries and today's metal prices, it's almost 50-50. 50% gold, 50% copper with a little bit of silver on top of that. So, which makes it attractive not just to the gold companies, but also to the base metal companies.
And Rudy, if I may just add a follow-up, given what you just said, you know, one of the things that's very clear, the gold price has had a big move in the last few years, but copper's had a significant move in the last year. And I would say more importantly than just the move in copper, it's the more consensus or believed view that copper is scarce and that copper prices are going to be higher in the future. My question is does that change the nature of the conversations that you've had over the few years? Because I would think that would bring a lot more seriousness to the discussions from the other parties.
Yeah, that definitely has. I mean, metal price is important in any negotiation. The scarcity of projects like KSM, I mean, you see being deals done. I'll just point to one that's in the public domain. Rio Tinto stepping in to buy, $25 million worth of stock from Western Copper that has the casino asset, a project that is not yet permitted, that is a tenth of the size of KSM and lower grades in gold and copper. The fact is there's not a lot of big copper opportunities available for the big companies to sink their teeth into, and KSM sits here as one of the largest and most advanced in terms of permitting. And then on top of that, with these metal prices, you're now seeing tremendous amounts of cash flow being generated by these big companies that need to be put back to work to find new opportunities for them to pursue. Even if you factor in all of the planned mine expansions and new mines that analysts tend to build in their spreadsheets, you still have copper in deficit in a big way over the next 10 years. And that's only going to grow as new green energy initiatives come into reality.
Another question for Rudy. Rudy, given that Canada, particularly BC, is a great jurisdiction to have a mine in, one of the key considerations in that great jurisdiction is Native relations. I was wondering if you'd give us a bit of an update on where the KSM project's been over the years with regards to Native relations and where they stand today.
Probably the most important part in advancing a project is maintaining a transparent and open dialogue with the Indigenous groups that will be affected by the project. That's been front and center for Seabridge since we started working diligently at KSM in 2007. We have 5 Indigenous groups that we deal with, 2 of which are the main ones, the Niska Nation and the Telltale Nation. We have impact benefit agreements in place with both of them, and both of those nations have been strong public supporters of KSM over the past decade plus. Without the support of First Nations, you're not going to get anything approved. That's just part of doing business. And it's the right way to do business. It was their land first. You impact their way of life. You have to find a way to work together.
Thanks, Rudy. Rudy, most of the questions are for you. I'm going to ask Jim another one just because I enjoy it. And I really appreciate the answers. So, Jim, if we look to the post-World War II era,
yep.
Which you believe we are in an analog to now,
yes.
What's the timeline look like? How long should we expect to be in this transitory narrative to the point where it gets bumpy and then we really get into yield curve management? Any idea on the timeline?
My guess is that we're going to see yield control by the end of this year. You know, it's going to depend a lot on the amount of issuance that the Biden administration is able to get approval for. That's the timing element. The more that they push out into the market, the more the Fed has to step up and buy, and that, in effect, brings you into yield control. In a small measure now, we have yield control at the short end. You know, they've been buying a disproportionate amount of short duration securities. So they're already playing with the idea. And if the issuance comes together that the Biden administration is seeking, then we're going to see it by year end.
Terrific. Thank you, Jim.
Okay.
Rudy, back to you. Any political concerns about Alaska drilling permits being withdrawn, not renewed? Other companies like Northern Dynasty, I believe, are having difficulties with decision reversals.
Well, first and foremost, we're not in Alaska, we're in British Columbia. So that's a positive. But even through the environmental assessment process, although it wasn't required, we brought in the U.S. EPA as well as the Alaskan Department of Natural Resources as part of the review process, because there is water flow that comes from KSM down into the Unic and eventually into the U.S. And what's interesting to note, coming out of KSM today naturally is very acidic water that's going into U.S. rivers, which is actually killing their fish. When we had our a town hall meeting in Ketchikan, Alaska, early on in the permitting process, the EPA stood up at that meeting and said, hey, we know why you're here, but understand that a mine here will improve the water quality. Because a mine here, whatever they touch, they have to treat, and as a result, the water flow out of the KSM area will actually improve with the mine compared to what's coming out of here naturally.
That's interesting.
First time in my career that I had the EPA.
Oh, I was going to say, say something nice. Next question, Rudy. With the First Stations update, can you bring the CapEx down? What do you see as the viable CapEx for you to finance the project with Seabridge as a JV partner? Sorry, a bit convoluted.
That's okay. Well, I mean, the fact is, if we're experiencing inflation, costs are going to go up across the board. We're already seeing pressure on steel costs. We're seeing pressure on labor costs. So if we can even maintain capital where it is with only a slight increase, we'd be very happy. To get it down below $5 billion, I think would be very challenging. A couple of things we are looking at. If you look at the KSM, one of the critical path items is the construction of the twin tunnels that will connect the mine to the mill. That actually is a 4 to 5 year timeline, which is the critical path item. Right now in our engineering studies, we're assuming only 5 meters of advancement per day from traditional drill and blast. There's a lot of new technologies out there that actually are driving tunnels elsewhere in the world at 10 to 15 meters per day. If we can shave off schedule on the tunnel construction, that will help in terms of keeping capital costs at a reasonable level.
Okay. Just to follow on, would you ever consider, or under what scenario would Seabridge put KSM into production?
Over my dead body? No, the fact is that, there's very few companies out there that have the systems, the financial resources, the technical resources, and the social license to develop a project the scale of KSM. KSM will be the largest mine ever built in North America, and probably will expand as a result of all the resources we have. From our perspective, there's no more than 7 companies on the planet today that can do the project justice. And those are the companies we are focusing on in our joint venture discussions. And our goal in a joint venture is to maintain a meaningful interest in the project, say somewhere between 30 to 40% of the project, but not have to come up with 30 to 40% of the capital requirements. We'd like to keep a meaningful level in the project while minimizing our capital contribution.
Thanks, Rudy. Unfortunately, most of these questions keep coming towards you, Rudy. Here's one just on valuation. If the gold ounces per share are so high compared to the competition, how do you explain the share price is not really taking off and the PNAV remains so extremely low?
Well, I think that's a function of not having a partner yet. We've talked about partnership, for a number of years. It hasn't happened. Therefore, the assumption is it's not going to happen. But when it does happen, believe me, we will see a big move in our share price as a result of that. The best company to Seabridge Gold is Nova Gold. They've got the Big Donlin Creek asset in Alaska in a 50-50 joint venture with Barrick, which gives the market, at least some confidence that the project can become a mine, having Barrick co-spending with Nova Gold along the way. If you compare KSM to Donlin, I would much prefer having our project, less capital, better economics, and a much longer mine life, and a lot of copper. So I think when the deal happens, we should start to unlock value almost immediately just by checking that box that this is a project that the majors are interested and will move it towards production. So I would expect to see a big move in the market after a joint venture transaction is announced.
Okay. Another technical question here. Why can't single deposits be developed individually with lower CapEx to get the ball rolling?
Because you have to put all the infrastructure in first. You have to put all your water management systems in for the entire project. You have to get your roads in. You have to get your tunnels in. They all have to be sized for the throughput you plan to go to. All that capital has to be spent up front. And then there's no other place to put tailings. We actually looked at over 15 different tailings facilities available, and the only one that worked for us, which we got permitted, is where we're at. So that is a challenge. So you can't mine them individually. You have to go into one processing plant and one tailings capacity.
Thanks, Rudy. I'm just going to ask another one to Jim, just to give Rudy a chance to take a break. Jim, one off the beaten path question. It really seems like other hard assets or real assets seem to have really taken off here in a much bigger, broader way than gold has. I'm thinking of real estate assets in the developed world and collectibles and other types of assets. I realize they're not as financially transactable, but those real hard assets seem to have been off to the races much stronger than gold so far this cycle.
Yep, that's true. Those are traditional places to put money. We've got long histories of doing that. In North America, gold has not been an option for many people. Now we're seeing guys like Sam Zell jump in, Jeffrey Gundlach, people who are, thought leaders in this environment. But still, gold is a kind of a sideways investment, something odd, something different. Everyone remembers Warren Buffett's various epithets about gold, that it's something you dig out of the ground and then you put back into the ground again and all that kind of stuff, although his organization did buy some Barrick for a while. So I think this is a function of the fact that we haven't yet seen the impact of monetary policy and fiscal policy on the dollar. When we see that, we're going to see people wanting a more liquid asset than real estate, and something that where they can transact in size, and you can in the gold market. There's $10 trillion worth of gold and gold stocks out there, and it has that kind of liquidity over time that very few other assets have. So I think it's simply a function of the relative stability that we've had up till now and the inflation showing up in other places. However, that's not going to remain as I've stated in my presentation.
And just one follow-up question.
Yeah.
There's been some commentary recently out of some very wise market commentators suggesting that although bit currencies and that the underlying technology are novel and very interesting and may have a big future, the notion that a bit currency can be a store of value when it moves upwards of 10 or more % in a given trading session makes it a very difficult argument as a store of value. Just curious your comments on that.
That's true. I think the volatility is working against Bitcoin and other cryptocurrencies, and you've seen the number of transactions falling quite precipitously recently with all the volatility. There's room for all of this. I don't think you have to say that it's either gold or cryptocurrencies. There's enough cash sloshing around in the world financial system to support both. The difficulty is that gold traditionally is part of the system. Central banks own it. And in fact, we just saw recently that the Russian Sovereign Wealth Fund has decided to dump all its dollar assets and concentrate more on gold. So that's in favor of gold, whereas Bitcoin is running into more and more difficulties because, as governments argue, it's a potential source of untaxed wealth and perhaps illicit transactions to support criminal activities. I'm not willing to argue against that, but we don't really know the size of that sort of activity within the cryptocurrency market. But it is drawing fire, and I think it's the reason why cryptocurrencies are down recently. Governments probably do not want citizens creating other currencies without their control. If I were a central banker, I think I'd take that view. So in the long run, I think we can be confident that gold will be a viable investment, and perhaps government policy, despite the attractiveness of the technology, will make cryptocurrencies more difficult to hold.
Okay. And guys, that's about the extent of the questions that I've got. Any final thoughts for viewers, Rudy or Jim?
Yeah, I'll just do a couple of closing remarks. First of all, I want to thank everybody that took the time to listen to the presentation today. I always appreciate the opportunity to get in front of investors and tell our story. If you have any follow-up questions, I'm always available for reach out. My email is Rudy, R-U-D-I, at seabridgegold.com. Please send me an email. If you send me an email, send your phone number. I definitely prefer the personal touch versus just a written response. So Bruce, thanks again for you and your team at Red Cloud. You've done a great job for us over the past few years, and we sure like having you on our side. So I look forward to our next encounter.
Rudy, it's always been a pleasure. Jim, any final comments for the group on the macro side?
No, I think due to your questioning, I think we've covered most of the key points. I do appreciate your questions. I know that you sometimes have different views from mine, but it's great to argue with you from time to time. Let's do it.
Well, I always enjoy you proving me right in the end, or proving me wrong in the end, Jim. So
we'll see.
So it's always good.
Okay.
Okay. Thank you, everyone, for the call, and we'll look for the next time.
Thank you, Barry. Thank you.
Thank you.